Thinking of exiting your business or taking on a private equity partner to help you grow faster? BizNexus has you covered. Tap into our network of thousands of best-fit investors, acquirers, and proven M&A advisors, and we'll help you begin the relationship confidentially on your terms, your timeline. Learn more at biznexus.com.
Disclaimer from the always present legal team. Podcast conversations don't necessarily reflect the views of BizNexus Incorporated. Everything you hear is informational news and updates from around the industry. We're not recommending any investments. We're not offering any investment advice. Be sure to do your own homework.
Hey everyone, and welcome back to The Deep Dive. We love digging into complex topics, and today is no exception. We're talking about private credit.
Ooh, exciting stuff.
It is. And it's especially relevant, I think, to anyone out there interested in those business deals, in that range of, say, $2 to $50 million.
Interesting.
Yeah, you send over some articles about this, and they really caught my attention. The private credit market is absolutely booming, like exploding.
It's incredible, isn't it?
It is. And it's almost doubled in value globally in just the past 3 years.
Wow.
Yeah, we're talking a massive $1.6 trillion.
Yeah, it's mind-boggling, the scale of growth.
It is. So the question is, what's driving this incredible surge, and what does it all mean, especially for our listeners?
That's the key question.
It is. And lucky for us, we have a finance expert here to help us unpack it all.
Happy to be here.
I'm really eager to get your take on this.
Yeah, the private credit market, it's definitely booming, and it's not just like a blip on the radar. This is a sign of a real shift, I think, in how businesses are getting the money they need, especially in today's world where things are a bit less predictable.
That's a good point. So let's break this down for everyone listening in. What exactly is private credit?
Okay.
I think a lot of people hear the word private, and, it sounds a little exclusive.
Yeah.
Maybe even a bit intimidating.
Sounds like, a secret club or something.
Exactly.
But it's actually simpler than you might think.
Okay.
Private credit is basically just lending, but it happens outside of the usual channels like banks or the stock market.
So not your typical bank loan.
Exactly. Instead of going to a bank or issuing bonds on the stock market, a company works directly with private investors or funds to get the money they need.
Interesting. So then why is everyone so excited about private credit, especially now? What makes it so attractive?
You hit the nail on the head with especially now.
Okay.
I'd say one word: stability. Public markets, they're all over the place. Valuations can swing wildly based on the news, speculation, someone's tweet.
Oh, absolutely.
But with private credit, it's different. Loans are evaluated based on the borrower's actual ability to repay.
So it's more about the fundamentals.
Exactly. It's a much more grounded, data-driven approach.
Yeah, I could see how that would be valuable.
Especially in these uncertain times, right?
Absolutely, yeah.
Yeah.
It's like, are you betting on a stock based on hype? Or are you really looking at how solid the business is?
That's a great analogy.
And I can see why that predictability would be so appealing to those businesses in that, $2 to $50 million range.
For sure, especially when you're trying to grow and, all this economic uncertainty swirling around.
Right, exactly.
It's about peace of mind.
So it's not just about feeling secure, right? Private credit actually offers some real tangible benefits for the investors too.
Absolutely.
For someone looking to diversify their portfolio, it seems like private credit has a lot to offer.
It really does.
Okay, I'm definitely intrigued. Lay it on us. What are those benefits?
Okay, so firstly, most private credit investments come with floating interest rates.
Now, you sent me some articles that mention this, and I think it's worth diving into a bit more.
Yeah.
Can you give us a concrete example of how these floating rates actually protect an investment?
Sure. Let's say you invest in a private credit deal where the interest rate is tied to, for example, LIBOR.
Okay.
As the LIBOR goes up, the interest rate on your private credit investment automatically adjusts upwards too, so it keeps pace with the market.
Got it.
This means your investment maintains its real value even when inflation is, eating away at the purchasing power of just holding cash.
That's a great illustration. It's like a built-in safety net.
Yeah, exactly.
Against those rising prices we've all been seeing.
Exactly.
Okay, so what else is on this list of benefits?
Okay, next up is low correlation.
Low correlation.
Yeah, private credit doesn't move in the same way as traditional investments like stocks and bonds.
Okay.
It kind of zigzags when they go up and down, you know?
I see. So not putting all your eggs in one basket.
Exactly, precisely. So it's a fantastic way to diversify your portfolio. If one sector takes a hit, your private credit investments might be doing just fine, helping to smooth out those bumps.
Okay, makes sense. Now, what about the bottom line, the returns? How do the returns in private credit compare to, other investment options?
Let's be honest, everyone wants a good return.
Exactly.
And historically, private credit has delivered higher average returns compared to those more traditional investments you mentioned.
Okay.
That potential for those, those bigger gains is what gets people excited about private credit.
I can see why. But hold on, this all sounds fantastic. But I'm sure it's not as simple as just deciding, okay, I want in on some private credit action.
Right.
How does someone actually get involved? Where do these deals even come from?
That's a great question, and that's what we're going to dig into next.
Perfect. Let's take a quick break, and we'll be right back to discuss that.
Sounds good.
Okay, so we've covered a lot of ground already, right?
Yeah.
We know what private credit is, why it's becoming so popular, and some of those key benefits, especially for investors.
Definitely.
But let's zoom in a little.
Yeah, let's get specific.
Especially for our listeners who are really interested in those businesses, valued between that $2 and $50 million range.
Absolutely. That's a great point. We often talk about the middle market as a whole.
Right.
But even within that, there's a lot of, nuance.
Right. It's not all the same.
And the lower middle market, which is typically businesses with, EBITDA under 15 million.
Okay.
That's where things get really interesting, especially for private credit.
Now, one of the articles you sent me, they called these businesses the hidden gems of the market.
Yeah.
What makes them so attractive for private credit investors?
Well, for one thing, they often face challenges getting traditional financing.
Oh, okay.
Banks can be hesitant to lend to them because they're seen as riskier, and they might not be big enough or have the track record yet to tap into public debt markets.
Okay.
So it creates this gap.
A funding gap.
Yeah, a funding gap that private credit is really well suited to fill.
So it's almost like private credit is kind of leveling the playing field, giving those smaller businesses a chance to get the money they might not be able to get otherwise.
Exactly. And it's not just about access, it's also about the terms. Private credit lenders are often more willing to structure deals that are flexible, and tailored to the specific needs of that borrower.
So they don't have all those rigid requirements you might see from a traditional bank.
Right, exactly. And let's not forget, it's not just a one-sided benefit. For investors, these smaller businesses can offer higher growth potential.
Which translates into bigger returns.
Exactly. It's that, higher risk, higher reward thing.
Sure.
But with that added stability and control that comes with private credit.
Right. Okay. You mentioned earlier that these specialized private credit managers, they're the key players when it comes to finding and vetting these deals.
Absolutely.
What's that process like? How do they find these hidden gems? What are they looking for?
It's a mix of, I would say, deep industry knowledge, a huge network of contacts,
right,
and a real knack for spotting opportunities.
Okay.
They're always attending industry conferences, talking to investment bankers,
right,
sometimes even proactively reaching out to companies they think could be a good fit.
So they're really plugged in.
They have to be.
Yeah.
And once they've, zeroed in on a potential deal, that's when the due diligence starts. They'll dig into the financials, look closely at the management team, analyze the competition, and really try to understand the company's long-term prospects.
I'm sure there are some red flags that would make a manager walk away from a deal. What are some of those warning signs?
Well, any sign of, financial wobbles, or if the management practices seem questionable, those are immediate concerns. And if the business model isn't sustainable or scalable.
In the long run.
Exactly. That's a major red flag. And of course, a lack of transparency or honesty from the company's leadership, that's a deal breaker.
Makes sense. If a manager feels like they're not getting the full picture, they'll probably walk away.
100%.
That's interesting. One of the articles you shared actually highlighted this case study where a manager walked away from a deal that seemed really promising at first.
Oh, yeah.
Because during due diligence, they found some discrepancies in the company's revenue reporting. It really highlights how important thorough vetting is.
Absolutely. It's a perfect example. It's not just about the numbers on the surface. It's about digging deeper, asking the tough questions, and making sure the information you're getting is accurate.
Trust but verify.
Exactly.
Okay, so let's say a manager has found a promising deal, they've done their homework,
Right.
and they're ready to invest. What happens next?
This is where the manager's expertise really makes a difference. They'll work closely with the company to structure a loan agreement that works for both sides.
So negotiating the interest rate, the repayment terms, any kind of covenants or restrictions.
Exactly. All of that. It's about finding that sweet spot where the terms are good for the investor, but also realistic for the borrower to manage.
And this is another reason why picking the right manager is so crucial. You want someone who's not just out to, make the most money for themselves,
Right.
but who also understands how the lower middle market works and can put together deals that benefit everyone involved.
That's key.
Now, earlier we talked about the importance of a manager's workout expertise, especially when things don't go according to plan.
Right.
Can you explain that a bit more? What does it actually mean to work out a private credit deal?
Think of it as a backup plan for when a borrower starts to struggle
Okay.
and might have trouble making their payments.
So it's about protecting the investment.
Yes, but also trying to help the borrower get back on track.
So it's a balance.
Exactly. It might involve restructuring the loan, giving them more time to repay, providing additional capital,
Right.
maybe even bringing in outside experts to help turn things around.
I see. But I'm guessing it's not always a happy ending, right?
You're right. Sometimes, despite everyone's best efforts, a deal just doesn't work out.
And that's why a manager's track record in dealing with these tough situations is so important.
Absolutely. You want someone who's been there before, who has the experience and the judgment to minimize losses when things go south.
It seems like choosing the right manager is really make or break in this space.
It's critical. They're your eyes and ears in the market, your negotiators, your problem solvers,
Yeah.
ultimately the ones responsible for your investment.
Okay, so we've covered a lot here. We've talked about why private credit is a good fit for the lower middle market, how managers find and evaluate deals, and why having a solid workout strategy is so important.
We've hit a lot of key points.
But before we move on, I want to go back to something we mentioned earlier. The IMF report and their recommendations for the private credit sector.
Yes, that's worth revisiting. Their call for stronger regulation and more transparency is really important as this market continues to grow so rapidly.
Now, I know we don't want to get bogged down in all the regulatory details, but can you give us the main idea? Why are these recommendations so important, especially for people considering investing in private credit?
Well, whenever you have a market that's expanding this quickly, there's always a chance for things to go wrong, for bad practices to emerge, for things to happen that aren't in the best interests of investors.
So stronger regulation is about setting some ground rules
Exactly. Ensuring fair play, protecting investors from potential risks.
to make sure everyone's playing by the same rules.
Precisely. And transparency goes along with that. Investors need to be able to see clearly how their money is being managed, what fees are being charged, and what the underlying risks are. It's about giving investors the information they need to make smart decisions.
One of the articles you sent mentioned that some private credit funds have been criticized for being kind of opaque about their fees and performance.
Oh, yeah.
It seems like this is something investors really need to pay attention to.
Absolutely. Don't be afraid to ask the tough questions, demand clear explanations, and compare different managers' approaches to fees and reporting.
It's your money.
Exactly.
Yeah.
You have the right to know how it's being handled.
All right, I think this has been a really insightful conversation so far. We've covered a lot, but it feels like we've just scratched the surface of this fascinating world of private credit.
It's a deep dive for a reason.
Wow, this deep dive into private credit has been really interesting. It's clear why everyone's talking about it, especially for those businesses in that, sweet spot between $2 and $50 million.
It really is a dynamic area. And for investors who, really do their homework, understanding how private credit works can be a big advantage.
Okay, so let's do a quick recap for our listeners.
Sounds good.
We've talked about what makes private credit different from traditional lending, the benefits, and why it's such a good fit for those smaller, growing businesses that might not have access to other types of capital.
Right. Those businesses that banks might not be so eager to lend to.
Exactly.
Right.
We also talked about how important those private credit managers are.
Absolutely.
Importance of due diligence. and how their expertise, especially those workout strategies, can really make all the difference.
It's not just about picking any manager. It's about finding the right partner.
Right. Finding someone with a proven track record,
Yes.
a strong network, and a real commitment to transparency.
100%.
And listeners, don't be afraid to ask those tough questions.
Yeah.
Really understand how they operate, what their approach to risk is, all of that.
You have to be comfortable with who's managing your money.
Exactly. Yeah. Now, before we wrap things up, I want to leave our listeners with some concrete steps they can take.
Okay, great idea.
So if someone's listening and they're intrigued by private credit, they want to explore it further, what are 3 things they can do right now?
Okay, first, start doing your research. Focus on those private credit managers who specialize in the lower middle market, those businesses with, EBITDA under 15 million.
Okay, so those smaller businesses we were talking about.
Exactly. That's where you'll find a lot of the really exciting opportunities, especially if you're an investor looking for growth potential.
Got it. So how do you go about finding those managers?
Check out their websites, read their articles and blog posts, really get a sense of their investment philosophy and approach.
So narrowing down the field, figuring out who aligns with your goals and your risk tolerance.
Exactly. Second, don't be afraid to reach out and connect with those managers. Schedule a call, go to a webinar, even see if you can meet with them face to face. Ask them about their sourcing strategy, how they choose the deals they invest in, their track record with workouts, how they handle fees and reporting. The more you understand about how they work, the better decision you'll be able to make.
Like any relationship, communication is key.
Absolutely.
Yeah.
You have to build that trust.
And
Finally, think about how private credit fits into your overall investment strategy. How much risk are you comfortable with? What are your return expectations? Maybe you're interested in specific industries.
All right.
Work with a financial advisor if you have one to figure out the right allocation for your portfolio. Make sure private credit aligns with your long-term financial goals.
It's about being strategic, not just jumping on the latest trend.
Exactly. Private credit can be a great way to diversify and potentially see some really good growth.
Yeah.
But it's not a one-size-fits-all solution. It's about making sure it's the right fit for your specific situation.
Great advice. Well, I think we've covered a lot of ground today.
We have.
Hopefully our listeners feel a little more confident, a little more knowledgeable about this exciting world of private credit. It can be complex, but with the right information and the right partners, it can offer some really amazing opportunities.
I agree. And remember, it's a constantly changing market, so keep learning, stay curious, and never be afraid to ask questions.
Well said. Thanks for joining us on this deep dive.
Thanks for having me.
And until next time, happy investing, everyone.
Acquiring a business? BizNexus simplifies it. Access thousands of updated opportunities in our DIY marketplace or supercharge team sourcing with OmniSource, your all-in-one platform for on-market, off-market, and coming-soon deals. Scale smarter today. Learn more or book a demo at www.biznexus.com.